Do stocks rise when the dollar falls? The market value of the US dollar has an impact on every segment of the economy, including the stock market. A strong dollar is synonymous with falling equity prices, while a weaker dollar can cause stock prices to rise. However, the relationship between currency valuations and the stock market is complex. A weak dollar is not necessarily good news for investors. The relationship between the value of the US dollar and the stock market is far from direct. That being said, a cheaper dollar can strengthen exports, which, in turn, can boost domestic profits and share value. This is just one example of the impact of value adjustments to the US dollar. Before 1973, the Bretton Woods International Monetary System determined the value of the US dollar. In 1973, the federal government decided to float the dollar. The currency's value is now based on supply and demand. Commodities including gold and oil are priced in dollars. Foreign investors buy dollars to make transactions involving dollar-denominated goods easier to facilitate. For the same reason, US companies and investors buy euros, pesos, and other currencies. Many foreign investors view the dollar as a safe haven investment and buy American currency when other nations experience economic problems. Conversely, investors often sell dollars when the US economy goes into a downturn. Historically, there doesn't appear to be a strong correlation between the strength of the US dollar and the way the stock market performs. The correlation coefficient measures either a positive, +1, or negative, -1, relationship between investments. The dollar has only about a 0.38 coefficient relative to the S&P 500, in part because the stock market is global and isn't solely based on how the United States performs. This correlation assumes that the dollar doesn't keep getting weaker, and that other countries don't lose faith in the dollar's overall strength. In the short term, the lower trading prices may entice investors and buyers for American-based companies, but in the long term, these companies may not fare so well. If the dollar drops in value, the price of goods denominated in dollars increases. Consequently, stocks in energy companies may rise as the dollar weakens. Imports become more expensive after a dollar devaluation, but foreign companies can acquire American goods at lower prices. This helps to drive up exports. As exports increase, profits rise, and stocks in US companies rise in value. Investors attempting to profit from rising stock prices may shift their cash from bonds to stocks. The increased competition for stocks drives prices up even further. The so-called day traders are sensitive to current economic trends. These investors help to drive up stock prices when the dollar weakens. However, other investors take a longer-term view and analyze the underlying factors that have caused the dollar to fall in value. Issues such as excessive levels of government debt may raise red flags and suggest that the US economy is headed into a downturn.